Hello, Culture Matters podcast. I'm so excited for this episode today. We are back with our investor series with co-host Aleck Arena of Arena Securities. Before Aleck introduces you to our guest, here's a quote just for this episode. You want to hold on to these businesses, allow them to compound. The whole point is to find these small businesses and watch them grow into larger businesses. Luke Winchester.
So I'll introduce Luke. Luke's a small microcap fund manager based out of Newcastle, so North Sydney or in New South Wales. I think he's a really switched on bloke. So it was first cab off the rank for the podcast. And we have some similar ideas. Probably understands tech a bit better than me, so I'll stay out of that and he can go into it a bit. But yeah, it should be an awesome podcast today.
Cool. Thanks for having me on, guys. I mean, you said the quote was from a famous person. I was expecting Buffett, but you didn't let me down too much with myself, I guess. Really stoked to be on, and leading off the investment part of the podcast series. I'm excited and keen to see where the conversation takes us.
Yeah, I was just waiting for your face, to be honest, Luke, for us to say it's Luke Winchester, but it's one of those quotes where I swear I've heard it before from other people, because it is how Buffett started. It's how most of your famous investors started. They started in small caps and they worked their way up. That's just like basic numbers and how numbers work. You want to go to the small, misunderstood part of the market and work your way up. And yeah, I think Luke's done that really well.
Well, even put the listed part to the side. I mean, every business starts off as a small business, doesn't it? Yes, they may list when they're a large business, but there's lessons to be learned beyond investing, just with the idea of being able to identify good small businesses that have the right structure and people and processes in place to become larger. I think it's important, and yes, it's obviously for investing, but just beyond into general business as well.
Awesome. All right, we're going to start firing away questions. You going to go first, Jay, or what?
I'd like to know, Luke, were you investing in your diapers as well, or did it hit you later? Did it hit you later when you were in the human resource and in the throes of
not quite as early as Aleck. I think Aleck was in diapers, wasn't he?
Oh, no, I was talking about myself. No, I'm just kidding.
Oh, yourself. Yeah.
No.
No, I was much later. In my path to investing, I often say people can relate to it because my path to investing had a lot of watching your neighbors get rich sort of element to it. I was watching my mates make money in the share market. This was back when I was in my early 20s. And at that time, I've said this before when I talk about my journey to investing, we had a mining boom in Australia. There was a period there for a few years where you could invest in any speculative mining company, drilling in outback wherever, and no matter what they hit, the share price would go up, and companies were pivoting to mining. And so, very speculative time. And one of my mates, I think he went on a holiday somewhere, and chatting to him when he gets back, and how'd you afford that? We're all broke uni students, and he'd made a few $1,000s in the stock market. And so, I wish I had this really interesting origin story about being brought into it by family members or something. But no, it was the classic watching my mates make money, and I thought, I want to get a part of that. So I did, and I invested in a few of those speculative mining companies and quickly lost everything. But it's such a good lesson to have that sort of experience up front, because it sets you then on the right path. And as I've said before, the investing bug just bit me at that time. The idea of putting money to work with other people and allowing it to compound behind their hard work and their expertise in areas that I just I can't match. So yes, I've pivoted away from where I started in that speculative stuff. But by and large, that was the origin story.
Luke, were you at the end of university or college, or were you like in the middle when you decided to invest? And like when you're investing, was it more just like the hot tip? Were you reading ASX announcements, or I don't think you're probably going to annual reports, or did you think you were a geologist at the time that was knew a lot about the mining sector?
Mm. It was the back end of university. It would have been maybe the last year or two I was there. And I think what was really interesting thinking back was I was purely following the hot tips, and I think a lot of people make that mistake. You follow someone else's work or conviction. You don't have it yourself, and inevitably things go wrong. But even then, I implicitly understood I wasn't just buying numbers on a screen or tickers on a screen. I was buying real businesses, and it was those businesses that weren't doing well, which was the reason why I lost money. So, then you flip that equation on its head. Well, what do I have to do to go and find good businesses that are doing well and will grow and will make money, and that flows to me and to others as investors. And then I was quite self-taught from there, to be honest. As you sort of alluded to, Aleck, I didn't really know where to go or what to do. Obviously, announcements and company reports and things like that. But I'd done a bit of basic accounting at university, but I had no formal training as an accountant. The numbers went a little bit over.
Cool.
I was lucky enough to find some like-minded investors. Back then was actually on Facebook. And that really kicked it off. I find people, they're so willing to share information and knowledge if you just go about it the right way, reach out to people. And that's what I was doing. I was so new. I didn't even know the questions I wanted to ask. I just knew I needed to, talk to these people and try and learn more. So threw myself into that. And yeah, so it was probably, from that last year of university, probably 2, 3, 4 years before I really built up the confidence to invest more. Even then, during that time, it was just quite small amounts of, my overall money. I kept most of my money just in, savings account or whatnot. But yeah, after a few years, I really thought I was getting the hang of it, if that's the best expression. I understood what I was doing, and I knew the businesses I wanted to find, and I had started to develop a process. Still so much to learn, and still learning today, but enough to really throw myself at it. Yeah, so that was sort of that part of it back then.
So by then you'd moved down from Newcastle, you'd moved down to Melbourne, you're working in HR down in Melbourne. And do you kind of remember your first small industrial business or your first small cap where you really put a thesis together and really put work behind it? Just in like obviously you were investing part-time back then. That'd be really, really interesting to hear.
Yeah, and just to go off tangent a little bit, my time in Melbourne was so interesting. I worked in industrial relations, and that's basically, the people in between unions, employee associations, and we were an employer association that I worked for. We were the Electrical Contractors Association, and again, I was straight out of uni, and I hadn't really experienced business, working with people. And it was very much getting thrown into the deep end. And it was a real eye-opening experience, because you have this, especially coming out of uni, you have this view of the world, a real textbook view of the world, right? Like, this is the way things work and everything's simple. And then I went and worked for this employer association, industrial relations, and I'm not talking out of turn here. It's fair to say that in Victoria, in particular, unions are quite militarized down there. Like they're very well organized and do a good job for their members. So that means it was like real feet to the fire sort of thing, and getting thrown into how businesses have to manage all these different stakeholders that you don't think of when you're on the outside. And so I think that gave me a really good experience as to, as I said, like acknowledging that in business, things are never smooth. Things always go wrong. And it's often, it's often not the fault of somebody or management or anyone in particular. It can be quite hard to manage. I think that's why, we'll talk about it some more later on, but having people who are flexible and can move with hurdles and things that pop up is so important. But to go back to your question about sort of the first sort of stock, I think everybody, when they embark on this investing path, and the people who, really throw themselves into it, you do usually have that one investment which just the stars align, it kicks off, and you sort of see the tangible benefits of what you've been doing. And for me, it's a business that's still listed. It's called Advanced Nanotech. ANO. Yep. It's on the ASX, and these guys they were making like really fine nano powders of metallic materials. So primarily, you're testing my memory here. I'm going back quite a way, but it was primarily I think, titanium powder and zinc powders. And it was just one of those things where the business itself just found itself in a sweet spot. And I, as an investor, found myself in a sweet spot. And what happened was there were regulations to remove chemicals out of sunscreen. And these guys, with their zinc powder, was able to be a replacement for the chemicals that were previously used. And the business was just taking off like crazy, growing like a weed, but really flying under the radar. And I was at that time in my investing where I'd built up the conviction in myself. When I thought I saw a good idea, I could really get behind it. And I think I made, I think it was over 10 times my money on that investment. And so that was that one that was just like really, obviously the tangible benefits when you put, a few $1,000s to work and you see it do so well, but just, it was also that real sort of reward, I suppose, for being doing this now for a few years. I really have conviction in this idea. To see it pay off so handsomely, that was the one that really sort of crystallized everything for me and said, all right, let's give this a go.
Yeah, awesome. Yeah, it is very interesting how you get started, and it goes back to your punch card kind of idea. I don't want to quote Buffett, but like goes back to the punch card where sometimes it's not you need to be in the right place at the right time, but you have to wait for that 1 or 2 or 10 opportunities there is, and you have to have the conviction behind it, and then you just have to sit in your hands pretty much. It's easier said than done, and you hear all the great investors talk about it, and it's quite hard to actually do. And then when you read all the stuff, you start jumping at shadows, it feels to me, because you kind of want that idea to come out, and you're searching for all this stuff, trying to find the idea. There's a fine line between, as Moshe Bryce says, like, have I been hit on the head by a 2x4 with the idea, or have I been chasing the idea like kind of too hard? It's kind of explanation he gives, because I feel like sometimes investors will want to find an idea really badly, and it could impact the way we think about the business, and impacts the way we should allocate to the idea. And it's a hard game investing, I have to say.
It is. And I think what gets lost on a lot of people, particularly when they're new to investing, is it's almost completely an emotional activity. Like, sure, there is, I suppose, a base level of knowledge that you need, particularly around numbers and things like that. It obviously helps, but you reach a point, and I think it surprises people how low that actually point is, where your base level of knowledge is enough for you to really succeed at investing. And what makes that next level is the emotional side of it. And I think it's important for people to understand their emotions and how to best control them. And one of the hardest things, and I can't remember who had the quote, or I might even butcher it, but the person who said the hardest thing in the world is for someone to sit quietly to their own thoughts, or something like that. Like the ability to be able to sit there and do nothing and have inactivity. Because go back to the famous quote at the start of the episode. Often the best thing you can do is get out of your own way, right? Like you've done the work, you've made an investment, you've deployed your capital, hopefully, to some good operators, some competent operators that have a real good pathway in front of them. Get out of the way, get out of your own way, get out of their way, and let them compound your wealth. But it's hard. It's really hard, as you said. Like, I think as humans, you have this innate wanting to do things. And then I think on top of that, I mean, so much the conversation so far has been back when I was a personal investor. And I think there's a lot of difficulties of doing that. But then, I've now pivoted to being a professional fund manager. And I've always thought one of the real curious things about this industry is, we charge a fee, obviously, on the funds that clients give to us, and we call it a management fee. So it implies this idea of you have to manage things, you have to manage your portfolio and manage positions and do things and be active. And often at times the best thing you can do is not manage things. Just go and sit on a beach somewhere and let a portfolio do well. But I think it's sort of, I could go on a huge tangent here. But
how marketable would a non-management fee be?
I think that's part of the issue. We've got this industry that has been built for so long on the idea that investment managers are gurus and experts, and you can't do this as a private investor. So you need to give me your money to manage. And it's quite ironic to me that the most successful investor of all time, Warren Buffett, has said for decades, like he's given us the instruction manual, right? He's told us what to do, but the difficulty is actually following it, because the secret sauce is just patience. It's just time and patience, and that's hard. It's really hard for people because you want to get rich quick. And as I said before, I started investing. You watch other people make money, and that creates this impetus to want to do things. So it's really tricky. It's I know some people say investing is incredibly easy but not simple, and I think that's a good way to describe it. The actual function, I think, is quite easy, but it's not simple. It's hard to do.
The advanced nanotech, what led to you not selling it at 5 times return versus 10? Like, was there something unique
at
that time?
That's a really good question. So for me, and different people have different styles. First few years really refining what works for you. And for me, what I found was I really enjoyed digging around and finding bits of information wherever I could about the businesses and how they were performing. And so, just to go a little bit in the weeds there with advanced nanotech, they were shipping their product to the US, to a distributor in the US, and primarily that's where they were seeing their growth and their traction. So it's an Australian-based business. Now, the US is one of the few countries around the world where import data is actually quite easily available to people. It's not actually, tucked away in government records. And so through websites online, you were able to track exactly the shipments this company was sending off to the US. And I kept a spreadsheet, and quite honestly, you're just seeing more and more shipments, larger and larger sizes going over to the US, and understanding that directly correlates to the growth of the business and the profitability of the business. So I was able to hold on basically because in the background, I could see the business. Even though the share price had done 5x, the underlying business was probably 10x the size, something like that from where it was. And I could see that as well. So I think that's for me, that's what worked, like, understanding what I was investing in and following that. But for a lot of people, it's called the old coffee can approach, where you find a good business, you buy it, you put it in a coffee can under your bed. That was back in the day when you got your share certificate, that's what you did with it. And you don't pay much attention to what the business does. As I said before, you get right out of the way and, let good people do what they do. So I think it's important for people to understand their style. There's no right or wrong. You can really make any of these styles work, be it more active, hands-on, more passive, sit back. But I think the key is finding the right people to back in the first place.
Yeah, I've used the term. It's like you're not outsourcing capitalism, but you are outsourcing capital to people that are running businesses, and you want them to have a basic understanding of like a capital allocation, maybe mental model in their head. Like in a share market, we'll refer it to as a framework, and where you want to be presented something as a set of investors, and like you want it to be accretive to a certain standard, or you want dividends, or you need the management team to have a certain understanding of how to allocate capital that's beneficial to shareholders. And if you have that and they stick to it over the long term, usually as a shareholder, you do very well. I just wanted to ask one more question, Luke. So when you first started investing, I feel like most people really struggle with the dislocation to price. So like their thesis, they'll think the market doesn't understand it and the share price should be higher for some reason. And then you're a retail investor sitting there, and one of the hardest things must be seeing your investment go up, but then also go down. And like they'll have days where it's not completely efficient, and it must be pretty confusing as like a retail investor trying to work that out. It's simple, but it's like it really does. I feel like for a lot of retail investors that test their thesis, and if you're trying to hold on to those multi-baggers, they're more likely to jump at shadows.
Mm-hmm. Yeah, no, I agree with all that. It's such an interesting point, and you've touched on a few different things there. First of all, I think the important thing that you said at the start was separating price and value, and they are two different things. I think at times also, it's easy for us as investors to say that, but as you know, the famous quote about the voting machine, weighing machine, over the long term, the price is a pretty accurate valuation of the business. It's those short-term dislocations that really throw people. Again, it's hard. To me, it all comes down to the conviction you have in the business, the work you've done, and I suppose your investing style as well. If you're the sort of person who takes a real hands-off approach to investing, then I think you naturally need to have a style that doesn't get shaken out by short-term price movements. I mean, that style sort of, you need to be able to have a long-term focus, and I think most people would if that's how they're going to invest. And ideally, that's how most superannuation or pension schemes around the world. That's the real benefit of them, right? It's money locked away, you can't touch it. It just compounds. For more active investors, like myself, yourself, Alex, it is hard. And the only answer to the question is, yeah, as I said before, having conviction in the work you've done to be able to identify what is a short-term dislocation between price and value, and what's potentially a signal being sent to you by the market that, hey, maybe something's wrong here. Because it's very hard. Like, you will make mistakes. We will all make mistakes. And nobody ever makes an investment thinking it's a mistake. Just by definition, it doesn't exist. So identifying them early, quickly, it's really hard to do. And I think the issue is some people, they rely on the signal from the market, with price, to be their determination of whether it's a mistake or not. So, you'll often hear people say, I bought a stock and it went down 20%, I sold, it was a mistake. Well, maybe. It depends. Like, if your thesis was strong and over time that business rebounds and plays out like you expected, then the sell was the mistake, wasn't it? And so I think that's where I would push back. A lot of people, they judge whether they've made a mistake based on the price rather than how their thesis has played out and how the business has actually executed. But it's really tricky. I mean, I always say it's really easy to do things like this and other podcasts and media that I've done. And the theory works so well. Like, we all know the theory, we all know the investing textbooks, but it's when you're there and you experience it, it's never easy. Like, it's really hard to see things in the heat of the moment. It's not until you often have the clarity of being able to look back after a period of time and be like, yeah, okay, I got that one wrong.
Yeah, it's it's the hardest thing in investing, knowing how to identify a loser. Like, obviously, some people have a bit more leniency with their theses than others. And I do think it's the hardest thing, because you don't want to chop something too early, because I've seen countless businesses that are amazing businesses and their share prices are driven by supply and demand. And I've seen the price go down 20% and the business still fight back after that. So it clearly wasn't, nothing particularly changed. The market just got a little less excited about it. So it's such a hard thing, actually putting it into place. And I don't think there's a right or wrong. I don't think there's a textbook. It's not that mathematical when it's like a share price has gone down 25%. It's now a sell. It's a case by case basis. So it comes back to what you were saying. You really have to have done the work. And if you haven't, you're kind of just playing a fool's game, or among, like, it's that if you haven't done the work, it gets closer to an idea of gambling to me. Because you don't really know what you hold. You don't know who you hold in the business, like what management team's involved and how they think about certain things. Sorry, Jay, do you have a question?
I have maybe a layperson question. Are valuations, if not higher, at least, are they either higher or at some point more volatile as a consequence of the access of information in society?
Yeah, that's a really, really good question. That's actually a fantastic question. I think the short answer is yes. And you've seen in general, valuations over the last, you could go back a long time, you could say 100 years, have steadily increased. And I think that's a function of a lot of different things. And the one you highlighted is probably the most key, which is there is more people investing, there's more money investing. It's easier to invest than it's ever been. There's a lot more information for people to make their own decisions or to outsource that to low cost, paths to market. There was quite a lot of friction to invest only, 20, 30 years ago. And so I think, as Alex sort of said, on a really basic supply and demand level, you have a general increase in the level of valuations. Now, rusted on value investors will say that really shouldn't happen. As a business, there should be a valuation for the future cash flows that can provide, and you discount that back and whatnot. But we don't, as I said before, we don't live in a textbook world where you pull out the instruction manual and this is how it works. You're in a market with other human beings, and there's emotions, and there's supply and demand and liquidity, and these are all the things that drive stock prices, particularly in the short term, but even over the long term as well. Long term structural changes to the market itself, and in particular liquidity.
What relationship has the spirit of value investing had in your ability to value or act out due diligence?
Sorry, you just dropped out. The spirit of value investing. What was that?
Like, what relationship, if at all, has the spirit of value investing had in your ability to value or like act out due diligence?
It's a really good question. So I know I sort of just dismissed it 30 seconds ago, but I will actually come back. I think it's really important for someone who wants to become more active in investing and throw themselves into the craft, to understand the mathematics, I suppose, of exactly what you're doing when you invest, because there's a quite well-defined way you would value an entity or an investment vehicle, and it's what's known as discounted cash flow. And it basically says if you tally up all the money that this vehicle, entity, investment product will generate over its lifetime, and I discount that back to today's dollars, because obviously a dollar today is worth more than a dollar in the future. So, mathematically, we know how we should be valuing things. The issue, of course, is that even a layperson can start to see the issues with the way you would apply that valuation to something like a business that's constantly evolving, constantly moving. How do I know what all of the cash flows in perpetuity into the future is going to be for this business? I can't. I can't even begin to model out what that would be. It theoretically goes to infinity.
We planned on having 2 children. We had 17.
Yes, exactly right. Yes, apply it to your household level. We all know how far a discounted cash flow model can go. But I think it is important for people to conceptually understand how to do that sort of valuation, because it is quite helpful. It then allows you to, once you understand the complexity of that, you can filter back and sort of say, okay, let's come back to a more simplified model of valuation. And most of them, despite being simplified, they take their core or their essence from that complex discounted cash flow. Like if somebody says to you, I'm buying a business on a 10 times price to earning, there's an implicit discounted cash flow in there. They probably don't even realize they're doing it, but that's coming back to that valuation. So yes, it's a really good question. I think it's important for people to understand that more textbook style to investing. But then once you do, I think the good investors are then able to, and again, I'm not a huge Buffett acolyte like Aleck is, I must admit. But he always, he's an investment savant, obviously. But he talks about being able to model something on the back of an envelope. That's because he's put in the work to understand the fundamental way to value things. And as a great investor, he's able to synthesize that down to say, I can get this down to the back of a napkin, and this is how I value this business. So it's super interesting. And again, I'm sure the conversation will go in a lot of different ways, but where I always push back on people who then try to keep using those sophisticated models, as they grow through their career. It comes back to that point before of you're trying to apply a textbook valuation to something that is constantly moving and evolving and growing and shifting and changing. And I think as investors, you have to be able to accept that volatility, not just share price I'm talking about here, but the business itself is going to be volatile.
Yeah, it comes back to the theory Buffett, I think it was the 1994 AGM. He referred to it as like you got to try to work out what's one bird in the bush. No, sorry, one bird in your hand, and I've got two in the bush. What would you rather take? And you have to try to work out. He's kind of trying to refer to a discounted cash flow there, but saying in a more hunter-gatherer approach of the world, if I was to give you $2 now or $4 later, what would you take? So yeah, it's definitely it's what I'm trying to explain what Luke was saying, but I've probably just done a worse job of explaining it. So yeah, Jay, do you have any questions?
Well, I think with my ex, I would have taken the two in the bush, but with my wife, it's always the bird in the hand.
So an Australian guy gets
there's
up.
a context. I'm just
Yeah.
I had at the same time. I have another question, actually. Or if you want to go.
Yeah, really rich doctor from Melbourne is the next questioner. Like from where Luke was, where Luke lived for a while, and he became rich because he owned a lot of Berkshire A shares, and he had, I think, $18.5 million worth of shares in the 2000s. And he used to go to the AGMs, and he said, "Oh, back in Australia, we would go for two birds in the bush every time." And everyone just started laughing because I remember listening to the audio of this AGM, and I was like, "That's just a terrible way to depict Australians." Like, us on the international stage, that's not us at our best. But yeah, you go, Jay.
So, I just wrote this down earlier. So maybe this is does understanding of management become more valuable in proportion to the access of information?
Yes.
Another really good question for a layperson. You're really onto it. I might just adjust it a little bit and say I think it becomes more important the smaller the business is, which probably is inverse to the level of information. Usually the bigger a business is and the more people are looking at it, you'll see more information. Management is so important. And I think it's really hard. And I'm glad we'll take the conversation in this path because now we're talking about the dark arts of investing. We're going beyond the numbers. Numbers are easy. Everyone can read numbers and crunch numbers and put them into spreadsheets. But now we're talking about the people running the business and having to make an assessment of those people and their character and their capabilities and competency. And you can't do that on a spreadsheet. There's no magic formula to be able to assess that. And as I said before, I think it's much more important for a smaller business. Of course, just proportionally, you're going to have less, I suppose, institution, bureaucracy, processes in place. It's normally much a flatter structure, and that manager can have a much bigger impact over the business itself. Whereas for a larger business, the CEO obviously, sets the direction of the ship, but the actual day-to-day operations is often left to a plethora of people below them. So I think it's super important. And as I said before, I think the hardest part for people and why it gets overlooked by a lot of people is because it's really hard to make that assessment, particularly, again, in the heat of the moment. You can often look back after 10, 15 years and identify the management teams who have done well and have grown a business. But being able to look at, maybe someone who's new to a business or a business that's new to you and making an assessment of the people, it's really, really tricky to do. And I don't have, I must admit, I don't have any secret sauce or things to offer. It's very much that ability that some people have that others don't, to be able to maybe assess character, be able to if they speak to management, ask the right questions and just get the right information out of people. It can be really tricky. I remember one of my colleagues, this is maybe going on a little bit of a tangent, but just an interesting point that's come to mind. We were talking about, businesses. There's this phenomenon where you'll often see a business that's perhaps underperformed and released a weaker update or a weaker result than was expected to the market. And sometimes what happens is you'll see a second weak result or a third one, and there's often, people colloquially will say, more than one skeleton in the closet or whatnot. And we were talking about, why does this happen? Like, why, if a business has some weakness and management, what causes the next period to be weak as well? And he floated up this theory, which really resonated with me at the time. And it was the idea that these people, when they get to executive roles and chief executive roles, they're high performing people. They are people who probably haven't had much adversity, if that's the right word, in their careers. They've executed and they've won. I don't like to equate it to winning and losing, but that's the sort of people that make it to these roles. And so when something goes wrong, they naturally trust themselves to be able to fix it. we can right this ship, we can fix this problem. And so, let's tell the market that was a weak period, but we'll turn this around and here's what we're going to do. And they're not used to the idea of, well, hold on, there's maybe something worse here, or I'm not able to fix it straight away. And that leads to the second. Often heads will roll at that point, and impatient shareholders will look to replace management teams. So it's really interesting.
It glitched. It paused there for a
Yeah,
second.
could you just rewind like 15, 20 seconds?
That was really good. The second thing you said, and then shareholders would.
Well, yeah, sorry, it's just, shareholders become impatient and just remembering, of course, that at the end of the day, management acts on behalf of shareholders. And so when shareholders become impatient, heads can roll and management teams can be replaced. And so it creates this really interesting dynamic, and sort of now we're getting into some interesting conversation around the relationship between management and shareholders. And I know that we started off the conversation talking about this really idyllic sort of situation where management are executing well and shareholders are patient with a real long-term focus on the future. It's what we all want, right? Management want that. We want that. But it's not always the case. And so what happens when things go wrong? And all of a sudden shareholders, their focus shortens to the short term, and management do the same. And, when you focus on the short term, you can sacrifice maybe what's being built for the medium longer term. And it's really interesting. You can get some short-term wins and share prices can react. And like I said before, when the price is a signal for whether you're doing good or bad, it can sometimes miss the fact that, what's happening in the background for the longer term health of that business.
I'd be curious if there's, whether it be management or let's say product, one being more or less important than the other, or if there's an order to it. It's less of one more than the other versus an order. It's this, then this. I don't really know where I'm going with the thought.
No, I get it. It's a good question.
Like, can a product just compensate for an incompetent management? Can a competent management compensate?
I think it can, and it probably creates a deeper question of, can an incompetent management team create a good product? Maybe by definition. I think if you're talking about
the Holocaust, no, I'm just
if you're talking about a business that creates like a physical product, and when you have a physical product, you can usually compare it to others, and you can make a pretty black and white assessment as to whether that's a better product than comparison. In that example, I think, yes, the product can really compensate for poor management. Usually where you'd see them show up as poor management is maybe investing in research and development for the future, maybe making poor capital allocation decisions around mergers and acquisitions or something like that. But by and large, if you've got a good core business, a good core product, it's hard for someone to come in and stuff that up. when it's genuinely a better product. Where it gets much murkier, of course, is a lot of businesses are services-based businesses and it's people-based businesses. That's where it becomes very tricky. And I think the importance of management, then it's paramount. And we're getting to the podcast name right now. This is where culture really comes in, because you're creating the business is the people, for businesses like that, for services-based companies. And it's all about attracting the right people and setting that right culture. And that's all done by management, of course. So I think it depends on the business. I think I own a few businesses which are real product-based businesses, and most of my work probably focuses more on making an assessment of the product. Is the product better than competitors, and what's the market like for what they're doing? But I then have some businesses which are more services based, and certainly that's where you're trying to make a deeper assessment of the people running it, because they're the ones really steering that ship and setting the long-term vision for the business.
You gonna go, Joe? Do you want? I was just gonna when you were speaking about R&D, it's it's a weird thing because like Alphabet and Apple have even done some weird R&D probably over the last 5-10 years where they're investing for the future at not very high rates of return, what feels like to be speculative products. But I think originally they had really good management teams, and then maybe the product's taken over and being that high quality that they have the surplus cash, and with the surplus cash they're doing somewhat weird things. I would say, and it's yeah. I feel like more professional management teams inherit businesses with a good product. It's not the bad management team accidentally creates a good product. I haven't seen that one too often. But yeah, anyone's got any thoughts on that?
I think it's a really good point, and again, touching on it on a few different things. As businesses grow and mature, and certainly as they get larger, I think there's a natural tendency for institutionalism to come in. And as you said before, that usually comes on the back of professional managers rather than, founders, entrepreneurs who have grown their business to where it is. And it's not necessarily good or bad. It depends on the business and the people. I mean, some businesses, if they're in an industry where there isn't a great deal of ability to reinvest back into finding growth, then having someone who can steer it as a mature business is probably the right thing to do. But for many businesses where, particularly if it was built on that real entrepreneurial spirit of really throwing things against the wall and seeing what sticks, losing that can sometimes really, really crush the business over the long term. And like I said before, what makes it quite difficult for investors and for the people in these businesses is, if you were to, if a professional manager was to come into a business that maybe invests quite a lot in R&D and, slash that back and cut costs and focus on a core business, you can probably report much stronger financial numbers in the short term and probably see a strong reaction to your share price, which creates the impression that you've done the right thing based on that scorecard. And it's often not until years down the track. And I was thinking to myself, before coming onto the podcast, I think there's been a really good example of this in recent years. I'm not sure how much reading you guys have done, but Boeing has had a lot of issues in the last couple of years, and a lot of people point the finger at the fact that professional CEOs have come into that business and it's really lost its, engineer-based sort of management that was there prior, and the focus being on the financials rather than the business. And it takes a very, very long time for these things to show up, which is the problem. You can do exceptionally well for a long time because the core of the business, which was built up for so long, is still very strong. And even though you're undermining it, day by day, it still stands for a very long time until, unfortunately, in that case, some things go catastrophically wrong. And that's the impetus for people to look at it and go, well, where did we go off track here? And you can often point back to the fact, well, we lost that North Star, which used to be our product, our people, and it shifted to financials and the market.
Yep.
which is why, my focus is very much always behind the business and the people rather than the share price.
That brings me to more of a theoretical exploration of like, what is equity? Like, what's underneath equity? And I use example like in the world, there's a push pull between like, you hear various initiatives like diversity, inclusion, equity is an example of an educational, awareness initiative. And there's some pushback in certain silos against the idea of equity. And I think it's because those that are non-shareholders, right? What does that mean for those that are non-actual shareholders? Well, it's more of like a cultural conversation.
Yeah.
So I'm using, just to try to piggyback and get somewhere with this, I'm trying to use that point. What is equity actually? Well, isn't it, people's time and space and their intellectual property?
Well,
It's how people are interacting or relating with one another as they achieve goals, like sub goals within the macro goals of the business, and how much
Well,
and how much can a management extract from a capital standpoint without long-term ramifications to the
yeah,
equity, to the people, like to the.
yeah. No, you're
I'm
asking
not really
some
quite clear on this
brilliant
thought,
questions.
like what is equity action? I'd love to hear it from like you guys, value investors.
Yeah.
What is
Luke, do
equity?
you want to go first?
Well,
Yeah,
let's take
sorry,
a
I'm
step
like
back.
jumped around a bit. Oh shoot, we lost you.
The,
Luke,
sorry.
Luke, sorry.
Say that again. Say that again.
We'll take a step back. I think the definition of equity there is probably taking on a few different facets, but I'll answer it from the financial point of view. So, equity is capital put into the business. So money, funds put into the business. And the term equity just means in turn for providing you with funds for the business, I have an ownership stake in that business. Whereas if I was to provide debt capital to you, you have to return my debt to me with some interest, but I have no ownership in the actual business itself. So from that point of view, equity is just, yes, some funds that are deployed to a business and you have an ownership stake in it. I think you were touching on such an interesting conversation though, which is how does a business balance the obligation that they have to their equity shareholders versus the various other stakeholders to that business. And also, I think it's a really interesting conversation which gets lost on a lot of people in the market. Balancing out the obligations to your equity shareholders across various timeframes. You may have a business that believes, look, we have a fantastic opportunity to reinvest back into ourselves and really grow this business. And 10, 20, 30 years down the track, we're going to be exceptionally profitable and be able to return you, excess profits back to you as shareholders. But up front, it's going to cost us money and we may need more equity. We may need you to put more money in, or you certainly won't be getting a short-term return for that. And so I think this is where that relationship with management, it is a two-way street. We often don't see it day to day. If you're a small private investor, you might not have a direct line of communication with an executive. But nonetheless, from a broader point of view, as I said before, management work on behalf of shareholders, and that needs to be a symbiotic relationship between the two to ensure it works. And then you touched on something super interesting leading into that question as well, which is, well, then what about the other stakeholders, employees, customers, broader society in general? I think that gets down a conversation path where I'm probably not best equipped to really dig into it. But it's super interesting, and there's a lot of different factors that go into it. And I think one of the key factors to something like that would be the broader, social, economic, cultural environment that the business operates in. There's some countries and cultures which, are very much pro business, and there's a lot more leeway, I suppose, for businesses to really maximize what they're doing. And then you have others that are much more pro environment or pro employees. And again, it's not necessarily a right or wrong. And I think businesses, they're eventually groups of people. Essentially, they evolve and adapt to whatever environment they're in. That's a super interesting question.
Well, I'll make it more specific, because the reason that came to mind was when you mentioned the Boeing example, where maybe the management that say their end game could have an inverse relationship with innovation, let's just say. So let's use our personal household. If myself, my wife, we take all of our money, out of our accounts, that's capital. Based on your definition, capital put into business is equity, and then you're going to get a ownership stake. So we take all our capital out of our home, our personal balance sheet. What's going to how are we going to get it back? Well, maybe we're going to have to work harder, eat less, spend less. Like we're gonna likely work harder and smarter. We're because the inverse of that, if we do less work, we overspend, we might end up bankrupt because we took the capital out. What's the replacement to replace it or to grow it? It's going to be our time and our space and intellectual property. So like for when the Boeing thing, if the management sucks the equity out, what has to replace it? The time and space and labor and intellectual property of the people. Now, what's the likelihood that they're going to want to replace it if they don't, they're not bought in or what have you. The reason I've experienced is just observing small business when the, let's say founder, if they suck the business dry, it's like, and they're not engaged, the people feel it, they know it, and then they're not engaged. So just maybe that makes it a bit more, you can draw on that a little bit.
Yeah, no, I'm with you. So let's clarify a couple of things. When we talk about deploying capital and equity into a business, the only way you can do that directly is by investing your capital directly into that business. Now, privately, that happens quite often. You'll have people privately invest with family and friends or whatnot. And you will give that money to them, and you'll get a share certificate that says you have an X percentage in that business. When you buy a stock off the market, though, a listed stock, that's a little bit different, and I'll probably just clarify that. So when you buy Boeing shares, as an example, you're buying it off somebody else. They're selling you their shares. No money actually goes to Boeing. You're just giving your money to somebody else. They've sold their shares to you. You now own those shares. So in the short term, there's often no impact from a equity point of view for a listed company when their shares change hands. Nothing's really happening. It's a transaction, by third parties essentially. Over the long term, what we would, from a textbook, we would call this cost of capital, basically. Like if you have a business where your share price is high, you're able to raise money at attractive valuations, and then you're able to deploy that at attractive rates of return. You can create a better business, whereas a business that is deprived of capital can often struggle. So that's just to clarify that point there. To come back to that example about a small business, and again, that's a super interesting one. All businesses need some form of capital in them. Just to run the day-to-day operation of the business, you need cash and you need something. So when you say someone stripping capital out of that business, stripping cash out of that business, they can certainly take excess capital out of the business, excess cash out of the business. If they start to strip out too much, then obviously it would then start to impact the day-to-day operations. That business, you need money to buy your materials and pay your suppliers. You need money to pay your employees, and without that, the business quickly falls apart. So I think when we talk about a small business, of course, that's always an interesting conversation. For bigger businesses, listed businesses where I mostly deal with, where you might see that become more of an issue is not so much management stripping capital out of the business, but replacing equity capital with debt capital. So what you may see there is, okay, this business needs X million dollars a year in cash on their balance sheet just to manage the day-to-day business and the operations. But instead of holding cash and holding shareholders' money, I'm going to give that back to them, and then I'm going to take out a loan and use that as my working capital and that runs the business. And you see that quite a lot. And particularly when you have share buybacks, high dividends, that can often support share prices, which is attractive to management teams. But it inherently brings a lot of risk and fragility to the business, because all of a sudden, any sort of hiccup to the operations of that business, when you have equity shareholders, it's obviously non-recourse to them. They can often tip in more equity capital if need be, but debt's a different beast. Debt holders, they can call their capital back if you breach a covenant. They can, do that when the business is on its knees, and that's basically for most businesses. It's debt that kills them. You very rarely see a business that's well capitalized. It's almost impossible, really, to go into bankruptcy without debt. So it's a super interesting conversation. And then I think you sort of at the end there pivoted into, well, what happens to a company culture when you have management teams that are sort of running the business for the financial outcomes and for the short-term outcomes. That's super tricky, isn't it? Like, we're talking about businesses, particularly, as I said before, those services, people-based businesses. In the short term, then you lose that.
Well, this I want to throw this out for you, both of you guys. The bird in the hand, two in the bush. The employee chooses the bird in the hand. The entrepreneur chooses two in the bush.
Yes.
Two different paradigms of psychology.
Not always.
Yep.
I was going to ask Luke a question about how he thinks about incentivization structures for employees. So that kind of leads into where exactly you're going into. So like with management of a small cap, I think for you, you're probably going to say case by case basis. If you were to give out options, a value investor traditionally thinks about options to management as a bad thing, and that management should buy their shares just like everyone else. Obviously, what was your opinion on that topic?
Yeah. It's such an interesting question, and it is multifaceted, and very much it comes down to the individual circumstances. But it basically touches on Jay's point as well, which is, how do you have your employees focus on the birds in the bush rather than the bird in the hand? Of course, when I put my labor into this business and I need to be compensated for that, we all have bills to pay, no doubt about that. But can I create a culture and a workforce that is focused more on the long-term thing that we're creating rather than any short-term outcomes they can get today? There's a lot of different ways to go about it. There's no right or wrong answer. The most common by far is share-based compensation, be it options or an employee share scheme. I think they I think they work. It's certainly better than nothing. But it's all about the structure, and I think what gets lost, and it's often quite hard because as investors, we're on the outside looking in. Bear in mind, for a lot of these things, we're not in the business day to day experiencing the culture. But I think what goes in hand with the actual remuneration itself, it's what is it tied to? I think some businesses get into the habit of having share-based payments or remuneration simply because it's the industry standard. I mean, particularly for something like tech, it's almost accepted universally that if you need to have share-based payments as a tech company. It's just one of the forms of remuneration for your employees. I think sometimes it gets a bit lost of, well, what are we benchmarking that to? What are the incentive structures we're creating around that? And like I said before, if all you're doing is shifting short-term remuneration from cash to shares, okay, that's fine. But the whole point of shares and equity is to have that ownership in the business, and ownership is what hopefully creates that long-term mentality that, I'm not just an employee who gets paid to work here. I'm building up an ownership in this business. And if I work hard and if my fellow employees work hard, we can build this into something much bigger 10, 20, 30 years down the track, even long after I'm gone. And I can still be reaping the rewards because of my equity ownership that I've built up over some time. And it's really tricky. I think it's how it's structured, it's how it's benchmarked, how it's communicated to employees. I have some friends who work for businesses that have share-based remuneration, and they simply sell their shares as soon as they get them. They just don't view them as that sort of compensation. It's just, it's an extra hurdle for me to get the cash that I should have got in the first place. So,
Wow.
having them set up and structured in the right way. And like I said before, the ultimate goal is to create the culture where your employees are also sharing that ownership mentality and that ownership vision, which that's what they are. When they own shares, as we said before, shareholders are the ultimate owners of the business. So you want them to have that. So yeah, whether it's management teams or lower level employees, I think listed companies, I don't think enough listed companies do enough to really promote themselves to their employees, and really not, you never want to force people to do things, but encouraging employees to buy shares, because, it's one of the, if you have a private business, it's really hard to do that. But if we're a listed public business, you can, open up a brokerage with anyone and buy shares and encourage the ownership mentality rather than trying to force it, I think is super important.
I think in small caps it would create kind of a cultural leverage that we don't see as much. Like, I'm just thinking about some of the small businesses that we own or I own, and if all the employees were a bit more bought into the business, obviously you do get that owner's mentality. I think that's such a good thing, because then everyone's concerned about how the business is tracking because they own shares in it, and they think with more of the ownership mindset of like how to cut costs and how to be not how, you don't always want to cut costs in a business, but like it comes back to your capital allocation framework of like how can I, even as an employee, allocate capital in the best possible way. But some people just have the employee mindset of I check in and I check out of work and collect my check at the end of the week, and it's a hard methodology to break.
Yep. And I think one of the other difficult things is, if it's a private business, you obviously don't suffer from this problem, and more private businesses, I think, should really leverage the idea of having share-based remuneration. For a public business, though, the volatility of price can often be quite scary for companies and employees. Because some people, as I said before, if you're tying your equity remuneration and you view it as more of a, it's part of my salary, and all of a sudden, I was on $150,000 a year, but because the share price is down now, I'm only getting 120. That's a $30,000 pay cut. That's how some people will view it. And so, as I said before, it's obviously providing them, I think, is better than not. But more importantly, it's really, sitting down with employees and explaining the benefits of it, making sure they understand, why it's in place, what it's trying to achieve, and trying to get that vision. And it all has to come from management, right? And to touch on something you were just sort of going into, which is the idea of employees. Listen, cut costs isn't the right word, but being focused on maximizing the business and its growth and its profitability. I think like all culture, it starts from management. I mean, if you're an employee and you see the executive team and the CEO, they're flying, passenger class on the airplane, that's what you're going to do, right? If you see that, when they stay somewhere, it's a 3-star hotel, not a 5. That's what they're going to do. And so, I think, like a lot of things, that sort of mentality, it starts at the top and has to feed its way down.
Yeah.
What do you think about this? Entitlements without proportional respect compound resentment.
That's really interesting, and I think we're getting into it again. It's probably a topic that there's many more people better equipped to go into than me, but I'll provide my opinion nonetheless. Culture is one of these tricky things, and people think you can just apply a universal culture to a business. Cultures, ping pong tables, and bean bags in the staff room, sort of thing. Culture is. It completely depends on the business you want to create, and to me, culture just means you're hiring the right people for what you want to achieve. If you have let's say it's a company, an investment banking company like a Goldman Sachs or something like that, and there's a lot of negative headlines, right, about 80-hour work weeks and the culture that they put on their particularly their graduate and young employees. But that's a business that creates a high performing culture, and performance is tied to the revenue you bring in for the business, and the more you work, you do that. So that's the sort of employees you're going to attract. That's the sort of employees and the culture that you want to foster. And that can be completely different to, as I said before, maybe a tech company that's more laid back and promotes and focuses on different things. And so the high performing investment bank, that remuneration structure is probably going to be mostly monetary. That's that's the sort of people they attract. It's the employees that they want, and they come and work. They want to work for them. Whereas for the tech company, work from home, flexible hours, the ability to work remotely, have a diverse team, a wide range of tasks, can be very, obviously we all come back, you need some base level of compensation, right? Monetary compensation, but depending on the culture and the people that you've built over time, the other factors that come on top of that can be very different. And I think you're right, Jay. For me, I've seen it firsthand in a lot of places where I've worked. It's for a lot of people, one of the main things that motivates them beyond obviously the paycheck at the end of the week is business.
Sorry, Luke, can you rewind like 20 seconds? You cut out where you're at. What motivates people besides the paycheck? I think you.
Oh, sorry. Yeah, just beyond the paycheck, it's when a business is providing responsibilities and the ability to grow and develop as a person in a career. I think that's the thing that a lot of people, especially a lot of new managers and entrepreneurs, miss when they begin having to manage people. As I said before, every incremental dollar has less and less motivation for people, and it has to be those other factors of I can help you grow and develop. I can give you more responsibility, more task, more meaning to the work you're doing. And it can be tricky, actually. It can be really tricky for people to manage that balance.
What are you reading? What's your learning process look like these days? Has it evolved over time?
It has evolved. So again, I don't want to make it seem like my path to investing is the right one. Everyone achieves it in a different way. Like a lot of people,
Hold on. You're the first one, so this is like Plato. Everything after Plato is just a footnote.
All right, so I am the right way.
Plato, it's like, sorry, just fun.
No, so I started off like most people, which was reading all the great investing books, and you spend your time, and I think it's very valuable to do. Like you got some of the greatest minds in the investing world, and they're sharing their thoughts, processes, and view of the world with you. I think it's brilliant. But I have evolved. I don't read many investing books nowadays, and I think the natural evolution that I had, and I'm not saying this is the right one, but the one that I had was once I'd built up that base level of knowledge and experience, I just wanted to apply it to as many real world examples as I could. So most of my reading nowadays is company reports, company announcements, and diving into the actual businesses themselves. You get a lot of information out of particularly a company's annual report. A lot of that's obviously companies are required to do it. They're regulated to provide a lot of that information. But most, provide quite detailed updates on their operations, their people, things they're doing, and they don't have to, but they obviously feel an obligation to their shareholders to provide this information, and it's brilliant. And a lot of people sort of overlook it. They'll go straight to the numbers or straight to the future outlook, and sometimes skip pages and pages of really valuable information about the actual business itself and what they're doing and what they're trying to achieve. So yeah, I have evolved. Most of my reading is that sort of stuff nowadays. I must admit, I float around online just reading various different things I can find. Like, I do enjoy reading investment write-ups from other investors. They'll often write about new ideas and new businesses, and sometimes I will take an idea and dig into it, but more often than not, I like reading about businesses. So
Yeah, I think you mentioned on
when
a podcast that you have, there's 100 or 180 or so people that you'll follow, and you'll kind of siphon their information. Can you elaborate on that a little bit?
Yeah. So I think that was my Twitter account, or X now. I've got, I think it's about 200 people that I follow, and so that's pretty tightly curated.
Wow.
And Substack now, I think, is a brilliant resource. Substack sort of replaced a lot of blog type sites. So I follow, top of my head, 15 or 20 different Substacks. But it's basically just finding where people are talking about businesses and investments, and some resonate with me more than others. As I said before, some are very numbers focused, and it was obviously important, but really what I like to read about is businesses themselves and business models. One of the best reads I've had, and I might try and find it if you can put it in the podcast notes or something. I think it was on Seeking Alpha, and it was an article about sort of the decline of Nike and what's happened to Nike over the last few years, and it was really interesting. It was about how they shifted their distribution from using retailers to having their own branded stores and also online sales, and you've built up this network of loyal, Foot Locker and all these other shoe retailers, and you just, not overnight, but over the course of a few years, shun them to the side, and it gave the opportunity for other brands to then take that space and leverage and compete. And I found it super interesting. It's not a space I'd ever thought about too deeply before, and retail is not a space in general I sort of gravitate to, but I found it super interesting. And it was to go back to something we've covered a few times, it was a new management team, and this was the strategic shift we're going to do, and it was really different to how that business had been run in the past.
Yeah, I can see what they were doing there, but for me, it's like they like their audience was much younger than the people they were selling to, and they kind of killed the hype around going into your stores like Foot Locker, and you go get a pair of Nikes, and that's like, I don't know, there's an environment when you go into a Foot Locker store, and there's, like, as I said, there's a certain hype around it and excitement. If you're just going into a Nike store, there's no like fancy lights, and the music's different, and you don't, like, the employees they feel more lethargic, to me personally. And I feel like across my generation, it feels like it's very noticeable. In like the last 5 years, it feels like since 2019, their brand probably somehow has peaked, at least in Australia or in my local community. And now it's like, it's not as sought after that people want to go out and get a new pair of Nikes. They will go to the alternative brands, and they still end up going to the same shop like Foot Locker and that, and they just don't buy a pair of Nikes. It's a bit weird.
I think just on that example, I think it's interesting. Like our opinion in the finance world is often guided by what the business is doing and the share price, and Nike has suffered in that respect. I suspect the brand itself is still really strong, and probably can be salvaged with the right moves by management. And it goes back to what I said before about Boeing, and I think GE is another really good example over many decades. It often takes time for these institutionalized processes and bureaucracies to really undermine what was built previously, particularly when it comes to brands and products and things like that. But it can happen, and if the right moves aren't made by the right people, then you have seen many businesses that were once stalwarts slowly
Yeah.
fade to obscurity, and the next generation come. I mean, it's capitalism. That's business in a nutshell, isn't it?
What did Nike
Yeah, I
do?
haven't.
They
Yeah.
went to their own stores versus scaling from
Yeah.
other
Yeah,
people.
they used to distribute through third-party retailers, and a new management team came in and shifted that to some first-party Nike branded stores, and also focused on online distribution directly through the Nike online store. And of course, like a lot of things, I'll try and find this article and shoot it around to you guys. Particularly because of COVID and the spike in online shopping, the initial strategic pivot seemed like it was working really well. There was a boost in sales, and it was until a few years come down the track where all of a sudden, you realize we have lost a bit of market share to some of our competitors because, you know, consumers, as Alex sort of said, consumers were going to these third party stores, and yes, they were buying Nike when they were there, but they may not necessarily have been going there for Nike, and they wouldn't go directly to Nike just to get Nike. They were still going to these stores, and they were buying Puma and other
Yeah.
brands because they'd now taken that premium shelf space that Nike had vacated. So it was super interesting. It was just about how management teams, you set these strategic drivers for the business and strategic pivots, and it can be really hard to assess short term versus long term. And I know I've said it a few times, but it's often not until you have the clarity of being able to look back in hindsight and say whether something was right or wrong. It's really
Yeah.
hard to see in the heat of the moment.
Well, I
But if
wonder
I
how
was,
when consumer behavior, like what relationship, if I go to a store to buy shoes, and for whatever reason, like once I get there, I can't make a decision because there's too much information for my brain to make a decision. So I end up just deciding on the brand that I have a bank account in my mind with. And maybe Nike will
Mm.
have that mind share.
I,
I
I
would
think what's
just,
really scary,
Like I've gone to,
if you want to,
like gone to
you
the
want to,
bookstore to buy books, and then I go to get one specific book, and then I leave with like 7 books I didn't
yeah. Well, on that
desire.
topic, it's
well, Luke,
Little
you
little
you
lag.
broke
We,
out
we had a
like
little
sorry.
10,
lag.
15 seconds there.
Read up about the psychology of retail and the tricks that retailers use to have us buy things, and things like shelf placement and colors and pricing. There's all these little different tricks and things that they do, and as you said, Jay, you can walk into a shop and you want to buy one thing, and all of a sudden you've walked out with 5 or 6 or 7. That's not an accident. It's well designed to maximize that dollar. And so, to go back to that Nike example, when you were going into Foot Locker, and you walked out with Nike, like, of course, you know the brand and it resonates with you, but it's also at that moment, the way it's presented to you, and the Foot Locker staff who may be incentivized in the background. There's a lot of different things that go into it.
I feel like they did that really, really well for Locker, and Nike hasn't done it as well because I once was a teenager not very long ago and a value investor on the side. And I remember walking into Foot Locker and all the lights around the store and where the shoe, as Luke said, where the shoe was placed, and like it's kind of like how the shoe was hyped up. And you walk into a Nike store at your local shopping center, it's just like the room's not as dark, and it's not highlighting the new cool shoes, and the store's just like lit up in a white light, and it doesn't feel like they're displayed in the same ways that Foot Locker displays the shoe. So I don't know. It definitely is what Luke was saying. The tricks of retail and how they sell stuff to consumers. I feel like they haven't done that as well.
Luke, what advice do you have for listeners that have a desire to invest through third parties in this, world of value investing? So like they're interviewing, they're accredited, they're interviewing asset managers like yourselves, right? The lay person that is a business owner listening to this, or an executive listening to this,
Mhm.
that's saying, I want to get involved in this, but I'd much rather, have my capital involved in this, not me do it. Like what
Yeah,
advice
yeah.
would you have for the listener to go about that interview process and partner with the right people and things?
Yep. it doesn't have to be extensive, but just taking some time to understand, the person or the people behind the investment. And I think quite honestly, it's making sure that their investment process and philosophy aligns with yours. And do they do what they say they do? So for me personally, and what I do with Merryweather Capital, we're primarily micro and small cap focused. And that I think over the long term will generate us some really strong returns, as we're talking about, finding good small businesses and letting them compound and all those nice things. But in the short term can bring a lot of volatility. I mean, small businesses, I said before, the fact that they're small have some business volatility. The fact that their shares are often illiquid can bring some share price volatility, and so you can have a lot of movement in shorter periods. And so there's some people who they may come to me and I would quite honestly turn them away from what I'm doing if there's someone who is in a stage of their life where their capital preservation and stability of their investments is something they value, then I'm not right for them. The second thing, and it's so important, everyone talks about it, but it can never be overstated, is make sure your manager is invested alongside you. I think one of the worst things you can do is give your money to someone who is a professional manager that has no financial incentive. And to go back to our conversation on remuneration, I mean, make sure they're not just gifted money that's invested into the fund. Like what you really want to see is, as you said, Jay, you're taking money out of your savings, you're taking money out of the mortgage, and you're investing that alongside your investors. It's your own hard earned that's going there. And I just think what you'll naturally find is that in our industry, it's called OPM, other people's money. When you have people who invest with other people's money, they're just willing to be riskier and take on increased levels of risk to try and get those lottery ticket style rewards. Whereas someone who's investing their own money with others alongside it, it will just always be a much more different proposition for them. You're always focused more on the downside first rather than the potential upside.
Also, like what their incentivization structure is. So, like if they might be more willing to swing for the fences if they have performance fees at certain points in performance for the year. And yeah, a lot depends on that. Like I feel like I'm trying to echo Charlie Munger again, but I'm really not. I'm just trying to say, like, you'll know a lot about a person's what they're trying to do if you read their incentivization structure.
Yep. And another one as well is, most investment managers, whether it's a monthly or a quarterly report, maybe go back and read a handful of reports from a year or two prior, and just make sure that what they're doing and their philosophy and their process, it's remaining relatively consistent. You never want someone who is just stuck in their ways and this is how I invest, because investing is as we said before, a very dynamic world and profession. But at the same token, you don't want someone wildly swinging from investment style to investment style or differing philosophies. You want someone who's relatively consistent with what they're doing and saying and sticking to sort of what they know. And that's sort of how I have come up to where I am. I said before, I found myself investing in ASX micro and small caps. It resonated with me. I found, my edge in that space, and now it's just about staying there and staying consistent and finding those businesses and keep, honing that edge that I think I've got. If I was a investor alongside myself in Merryweather, and all of a sudden you saw me buying, European micro caps or something like, you'd straight away think something's changed here. He's sort of gone away from his knitting.
Did the investors that invested with Buffett's fund before Berkshire, did they get silly rich? I'm serious. I'm not sure.
Anyone who invested early enough with Buffett has gotten silly rich. But pretty early on, yes, there was trusts before Berkshire, but by and large, Berkshire has been a listed business for many decades now. So when you invested alongside Buffett, you were just buying shares in his investment vehicle, and similar to any sort of equity ownership, you then enjoyed the ride alongside him. So Yeah, and yes, by and large, if you were there early enough with Buffett, you've done exceptionally well.
Yeah, I think yeah, probably not relevant to highlight his performance or anything, but I think his structure around when he changed from a fund to Berkshire is something that's kind of important to highlight because then it was a permanent capital base, so no one could pull out their money and there wasn't inflows or outflows. It was there's Berkshire and Berkshire acted as an investment vehicle. So it was
Mm.
more like a permanent capital base, even though the tax situation was slightly worse. So he was more happy to have a permanent capital base than to have a slightly better tax situation. So yeah, it kind of highlights people's thinking, I would say.
Why would he prefer that?
He'd prefer that because when times are when times are good and then times change and like you have a sudden market gyration, you don't have a bunch of investors running for the exit. So it's important that also the investors are convicted in the managers that they give capital to, if that makes any sense. So like I can't speak for Luke, but if you want your investor base to be convicted on your style and you need everyone to be bought in mentally, as well as being bought in like with capital base. Like you need to be bought in mentally so they understand the investment process and they understand that markets move up and down and like you have a thesis and you wait for the thesis to play out if it plays out. It's yeah, unfortunately it's not a straight line up. It's you have you're investing in businesses and businesses like Luke said today, businesses have bad periods, they have good periods. They're run by people at the end of the day, and companies miss some quarters they beat expectations. Like I know I say quarters, for us it's more halves. But yeah, it's, you're investing in businesses at the end of the day. You're not investing in bonds or share prices that go from top left to bottom right.
Are the
I think
investors the customer? Or go ahead.
I was just going to add to that point. I think there are exceptions. There are some funds out there that have a lockup period where they take their investors' money and those investors can't access that money for a set period of time. Might be a couple of years, but by and large, most funds are open-ended, which means, and that's how Merriweather is. And it creates the issue that generally, as Alex said, most people, when they want to cash their money out, is when things are a bit hairy, a bit uncertain. And so share prices are usually down and investors are redeeming money. And as a fund manager, to fund those redemptions and pay them out, you have to sell your stocks, often at low valuations when you would least like to. And it creates this pretty ugly sort of flywheel effect where, you're selling stocks at a low to cash out money. And then, those stocks can often keep falling because you're being forced to sell. So yeah, I had it put to me. I launched Merriweather back in 2021, and I by then had built up a good network of fellow investors and several who had launched funds themselves. And the key piece of advice I got from all those people was you attract the investors you deserve. So if you are a manager who acts in their best interests with a focus on the long term, that's the sort of investor that's going to come and invest alongside you. If you're someone who is focused on short-term returns and chopping and changing styles to try and capture whatever is the theme of the day, then you're going to attract investors who are only after short-term returns, and they're the ones who are going to leave you at the first sign of anything going wrong. So it's yeah, something that's always stuck with me, with the idea of a fund. It's as much as what I'm doing as the investment manager, identifying good businesses, investing in them. As much as that's my core goal, the other key thing I always need to do is make sure that I'm really
Okay, this is so interesting.
cultivating my investor base. Yeah.
So are the investors the employees or the customers, and what's the product?
It's an interesting way to frame it. They would be the customers, and the product would be the investment vehicle.
They
And
might be
again,
the customers, but is their capital the labor?
Yeah, that's it. Again, it's a different way to
Like if
frame
my
it, but I
employees
think
walk out the
It's a
door
different way.
tomorrow, my widget
that's
factory
right.
closes.
Yeah,
I don't know.
and they can
This is
they
all just come in stream of consciousness. So I don't know.
yeah, no, it's interesting. And yeah, in that example, yeah, they can pull their employees at any time, and you know that's
Yeah,
who you need to run your business. You know, I need you know my investors' capital. But it's really interesting. And then to sort of, you know, take that metaphor a little bit further. I mean, how do you get new customers as a business? You know, some people really focus on marketing, and you know
yeah,
it's something I've done in the past. You know, you do media and things like that, and get your face out there so investors can find you. But to go back to, you know, again, it's an interesting metaphor, Jay, because to go back to something we said a long time ago. You know, a good product is often the best, you know, feature of a
sort of like,
business. And so if you've got a good investment vehicle that's performed very well over the long term, and you know you've got that, let's use Buffett as the example. You've got that Buffett track record. That in and of itself, that's what attracts people. That's what attracts
yeah,
customers. The product itself. As a new fund, Merriweather, we're only a new fund and they've been running a few years. We're probably more reliant on the marketing side. We don't have that long track record yet. We're still building that. So it's an interesting metaphor. I like that. I think you've come to something interesting there.
Well, it's
yeah.
easy because I'm so far away from this, right? The metaphors,
Mhm.
the ignorance. Well, in closing, Aleck, do you have any a way to tie this in a bow for our listeners? Luke's been
Not
amazing. I've had so many epiphanies. I got all these quotes I want to put out on threads here, Luke, of your quotes here.
yeah.
You got
You might have to keep pumping out the Luke Winchester quotes, Jay.
Yeah, you're
No, I
welcome
think it's
back
an awesome
anytime.
podcast.
This is amazing.
Yeah, maybe we'll have to line something up next year. Yeah, thank you so much for coming on today, Luke. I really enjoyed it. I know Jay did too. And yeah, yeah, thanks for your
Yeah.
time. And we really covered some interesting topics today. I was expecting probably more to go into the micro caps in Australia. But yeah, I think you had to kind of hit it on a broader base and at the start because yeah, obviously that's the best way to do it.
Yeah, no, obviously the first in the investing series. Maybe if we revisit in a few weeks or months, the listeners might be more well versed, and I can get a bit more in the weeds with, you know, stocks themselves and things like that. But no, I really enjoyed it. I think it was good to keep the conversation at those sort of high level concepts that I think everyone can sort of implicitly understand. We've all been involved in business in some capacity, right, as either running them or employees, and so you know, I'm sure maybe people hadn't viewed it through the lens of investing and things like that. But I think maybe we did a good job of sort of helping people take those experiences and sort of switch the view a bit, and you
Yeah,
know, think about, rather than view it as an employee or an entrepreneur, you know, how would an outside investor view this business? I think is also an interesting conversation. So no, I really appreciate it, guys, and I would, of course, be happy to come back and chat again.
yeah, awesome. Thank you so much. All right,
Yeah,
we better wrap it there. We can still stick around and talk for a bit longer, but I think yeah, we better wrap it there.
thank you so much. If you're listening to this podcast, follow Luke Winchester. Luke, what's the best place for people to follow you? Just one place?
Yeah, just I got a website, merriweathercapital.com.au. Jump onto there. There's a box where people can chuck in their email and receive, you know, fund updates and things like that. But yeah, that's the best spot.
If you're
Yep.
listening to this show, thank you all for listening. Make sure to go to the Culture Matters podcast and stalk Aleck because he's a regular. And leave us a review on the Culture Matters podcast, and we will see you next time. Thanks so much, Luke. Thanks, Aleck.
Thank you.
Thank you.